Hey everyone, welcome back to my channel. In today's video, we are diving into the world of accounting and tackling some common multiple choice questions from the books of original entry, depreciation, double entry reports. We will cover topics like depreciation, bad debts, provisions for doubtful debts, and provisions for discounts on debtors. If you're studying for an accounting exam or just want to brush up your skills, this video is for you. Let's get started. A cash discount is best described as a reduction in the sum to be paid, if payment is made within a previously agreed period. If payment is made by cash or not check, this is wrong. If payment is made either by cash or check, this is right. If purchases are made for cash, not on credit, this is wrong. Now, what is a cash discount in accounting? A cash discount, that is an incentive that is always offered by a seller to a buyer for paying an invoice before the scheduled due date. So in this case, a cash discount is best described as a reduction in the sum to be paid if payment is made within a previously agreed period. So normally these cash discounts are offered if the buyer is paying within an agreed period of time. In fact, these cash discounts are always offered for the buyers to pay or to settle their accounts within the agreed period. So if you're paying promptly, then the supplier will offer what we call a cash discount. So it's a reduction in the sum to be paid, but that is only if the payment is made within a previously agreed period. Discounts are deducted when we receive cash, given by us when we sell goods on credit. No. Discounts received are deducted when we receive cash. This is wrong. Given by us when we sell goods on credit. No. Deducted by us when we pay our accounts. Yes. None of these. Discount received are deducted by us when we pay our accounts. So it's a reduction in the cost of the purchases that a buyer receives from the seller. But this reduction is always made if the buyer is going to pay before the due date. So they will always offer a discount. Those are the suppliers. They will deduct the amount you're supposed to pay. That is, if you're paying your accounts within the credit period. So that's a discount received, deducted by us when we pay our accounts. Normally it's the supplier that makes the deduction, but that deduction is made when you pay your accounts. Total of the discount allowed column in the cash book is posted to the debit of the discount allowed account. So in the 3-column cash book, there will be a column on the debit side. That extra column on the debit side, it's for the discount allowed column. So at the end of the month, we have to total the discount allowed column, and that total is posted to the debit of the discount allowed account. The rest of the options are distractors. They are wrong. They are not correct. Sales invoice are first entered in the cash book, purchases journal, sales account, sales journal. What is a sales invoice? A sales invoice, that is a formal document. It's a source document that is always issued by a seller to a buyer, detailing the goods or services provided and the total amount due. So a sales invoice serves as a legal record of the transaction, and it is typically used to request payment, meaning that a sales invoice will always be issued when goods are being sold on credit. Sales invoices are first entered in what we call the sales journal. They are recorded in the sales journal. So the sales journal, that is a book of original entry which records credit sales, and we know that these sales invoices are always issued when goods have been made on credit. So sales invoices will first be entered in sales journal. The rest of the options are distractors, they are incorrect. The total of the sales journal is entered on. Now, after entering your credit sales in the sales journal, you have to total your sales journal, and then the total of the sales journal is entered on the credit of the sales account in the general ledger. So sales that have been made on credit, you will list them in the sales journal. At the end of the period, you have to get the total of the sales in the sales journal. Then you take them to the credit side of the sales account in the general ledger. The rest of the options just distractors. Given a purchases invoice showing 5 items of shillings 80 each, there's a trade discount of 25% and a cash discount of 5%. If paid within the credit period, your check will be made out for. So here you have a trade discount as well as a cash discount. So how much is the trade discount? Or how much? Okay, let's come up with a selling price, with a price after the trade discount. Because normally the trade discount is offered at the list price. So if the list price is 80, I have to minus 25% of 80 to come up with the price which you're going to pay. So the price which you're going to pay for each item. So 80 minus 25% of 80, you get 60. So each item will cost 60 after the trade discount. Each item will cost 60 after the trade discount. So total amount of purchases will equal to, there are 5 items, each shilling 60. So what is 5 times 60? That is shilling 300. That is shilling 300. But the supplier is offering a discount, a cash discount of 5%. That is if you pay within a credit period. So we have a cash discount. We have a cash discount that is 5%. So what is 5% over 300? That is 15. Cash discount, it will be a reduction in the amount to be paid. So the amount that will appear on your check is 285. So the answer is A when it comes to objective 6. An alternative name for the sales journal is sales daybook. So if they don't use the sales journal, then we can use the sales daybook. That's the alternative name for sales journal. Entered in the purchases journal are payment to suppliers, trade discounts, purchases invoice, discounts received. What is a purchases journal? A purchases journal, that is a book of prime entry that records credit purchases. So when we try to look at all the options, it is the purchases invoice that will be entered in the purchases journal. Purchases invoice will be entered in the purchases journal because the purchase invoice will be received, that is if goods were purchased on credit, and the purchases journal records credit purchases. Total of the purchases journal is transferred to the debit side of the purchases account. So from the purchases journal, you have to post the total purchases from the purchases journal on the debit side of the purchases account. Credit note issued by us will be entered in our sales account? No. Return inwards account? No. No. Return inwards journal? Yes. 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 So here the answer is C. Return inwards journal. That is where the credit notes issued by the business will be entered. Return outwards journal? No. So what is a credit note? A credit note issued by the business, that is a formal document that indicates a reduction in the amount owed to you by a customer. Of course, it is always issued in case goods have been returned. So if a customer returns goods due to maybe defects, due to damages or incorrect items, then they will issue what we call a credit note, and that credit note will be entered in the return inwards journal. Total of the return outwards journal is transferred to the credit side of the return outwards account. So from the return outwards journal, that total of the returns will be transferred to the credit side of the return outwards account in the general ledger. We originally sold 25 items at shillings 12 each, less 33 and a 30 trade discount. Our customers now return 4 of them to us. What is the amount of credit notes to be issued? So goods were sold, there is a trade discount, but now some of the customers are returning the items to us. What is the amount of the credit notes to be issued? So the first thing you have to do is to get the price after the trade discount. Price after the trade discount. How much is the price of each item? Because now there is a reduction at the time of purchase. That is the trading discount of 33 and 30%. So my price after the trade discount, we sell each item at 12, but there is a reduction of 33 and 30% almost 12, because that discount is going to be applied on the list price. So we have to see our list price after the trade discount, because there is a reduction of 33 and a third. There is a reduction of 33 and a third. There is a reduction of 33 third. So of course the reduction is going to be 4. When you get 33 and a 30% times 12, there is a reduction of 4. So 12 minus 4, that gives us shillings 8. So 8 is the new price after the trade discount. A customer returned the 4 of them to us. What is the amount of the credit note to be issued? So credit note amount would be the 4 items, but each item costs 8. So what is 4 times 8? 4 times 8, that is shillings 32. So shillings 32, the option D is the correct option there. Depreciation is the amount spent to buy a fixed asset. That is a big no. No, 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 no. No, no. So option 1, that is a distractor. Depreciation is the salvage value of a fixed asset? No. Depreciation is part of the cost of the fixed asset consumed during its period of use by the firm? Yes. So this is the correct option. The amount of money spent in replacing the assets? No. So depreciation, as the business is using that fixed asset, at the end of each year, there will be that part of the cost of the asset that they are consuming. Okay, so it's that part of the cost of the fixed asset that is consumed during its period of use by the business. That is depreciation. A firm bought a machine for 3,200 is to be depreciated at a rate of 25% using the reducing balance method. What would be the remaining book value after 2 years? So depreciation can either be computed using the reducing balance method or the straight line method, but objective 14, we are required to use the reducing balance method to determine the remaining book value after 2 years. So in year 1, your depreciation will be 25% of 3,200. I'm getting the depreciation for the very first year. In the first year, if you're using the reducing balance method, your depreciation is on cost. Your depreciation is on cost. So 25% of 3,200, that is shillings 800. Then in year 2, what will be the depreciation? That depreciation will be 25% times the book value. So how do you get that book value? In year 2, you have to get the cost of the asset, then you deduct the depreciation. Deduct the depreciation of the previous year. Deduct the depreciation of the previous year. So 3,200 minus 800, that is 2,400 times 25%, that is shillings 60. That is shillings 600. So our book value remaining book value after 2 years. The cost is how much? The cost was 3,200 minus the depreciation accumulated, because they want us to get the book value, the remaining book value after 2 years. So that will be 3,200 minus the accumulated depreciation. So that will give us how much? Our accumulated depreciation is 800 plus 600. That gives you shillings 1,800. So 1,800, that will be the remaining book value after the 2 years, and that is C. So C is the correct option. C is our correct option when you try to look at the options given. The rest are not correct. A firm bought a machine for shillings 16,000. It is expected to be used for 5 years, then sold for shillings 1,000. What is the annual amount of depreciation if the straight line method is used? Remember, under the straight line method of calculating depreciation, the annual depreciation charge will be the same. Unlike in the reducing balance method, where depreciation keeps on reducing, here in the straight line method, depreciation is constant in each of the years of the asset is useful life. So how do we compute depreciation? Using the straight line method. So annual depreciation charge, you get the cost of the asset minus the residual value over the useful life. So cost of this machine is how much? It is 16,000. Residual value is 1,000, the value of the asset at the end of its useful life, then divided by the useful life, which is 5 years. So how much is the annual depreciation? How much is our annual depreciation? So 16,000 minus 1,000 divided by 5 years, that gives us shillings 3,000. So the answer is D. The annual depreciation is 3,000 if the straight line method is used. So under the straight line method, the annual depreciation charge will always be the same. At the balance sheet date, the balance on the accumulated provision for depreciation account is simply deducted from the assets in the balance sheet. Remember, when you're preparing the balance sheet, there will be 3 different columns: one for cost, one for accumulated depreciation, and then one for the net book, one for the net book value. So at that balance sheet date, the balance on the accumulated provision for depreciation account is simply deducted from the asset in the balance sheet to arrive at the figure for the net book value, sometimes referred as the carrying amount of the asset. The trial balance, the balance on the provision for depreciation account is shown as a credit item. The answer is A. In the trial balance, the balance on the provision for depreciation account is shown as a credit in the trial balance. Okay, it's shown as a credit in the trial balance. The rest of the options are wrong. So provision for depreciation account, it has a credit balance always, so it will be shown as a credit item. Remember, it represents a reduction in the value of an asset. So it's a contra asset account. Its balance will be on the credit because a fixed asset account will always show a debit balance. So being that this is a contra asset account, it will be having a credit balance in the trial balance because provision for depreciation represents a reduction in the value of an asset, so it will be shown as a credit item. If an accumulated provision for depreciation account is in use, then the entries for the year's depreciation will be, if an accumulated provision for depreciation account is in use, then the entries for the year's depreciation will be. Now here they are asking you for the journal entry that is used to record depreciation. If you're to record the depreciation, what journal entry are you going to use when recording depreciation? When you're recording depreciation, we credit the provision for depreciation account and debit profit and loss account. We credit the provision for depreciation account and credit the profit and loss account. Remember, depreciation is an expense, so it will be debited in the profit and loss account. So the rest of the options are distractors. They are wrong. When the final accounts are prepared, the bad debts account is closed by a transfer to the profit and loss account because bad debts is an expense. So all expense accounts will be closed off by a transfer to the profit and loss account. Provision for depreciation is created when the debtor becomes bankrupt? No. When it has ceased to be in business? No. To provide for possible bad debts? Yes. So provision for doubtful debts is created to provide for possible bad debts. These are debts which you're doubting, so anytime in future they can turn to be bad debts. So according to the prudence concept, you have to provide for those possible losses before they eventually occur. So that is our set 3 of the multiple choice questions. All these questions have been answered. Where you feel like you need some more explanation, please comment, share your comment in the comment section. Share your comment in the comments section. So we have discussed the concepts of depreciation briefly, bad debts, provisions. Remember, these are essentials for managing assets and liabilities. So if you found this video helpful, please like it, share, and subscribe. And don't forget to hit the notification bell to stay updated on future videos. Thanks for watching and happy learning. Bye-bye.